Hi, I'm Greg Weldon, and welcome to a special edition of my Global Macro Strategy Reports, the daily newsletter that I do. We manage money, we do a lot here. But today, I really just want to put this out there to as many people as possible, talking about just kind of a crazy, off-the-wall idea where if you had a bond market crisis right now in the U.S., and there's reasons I'm going to show you where that's not as outrageous as it might sound just for face value. But if you did, and we already know the purchasing power of the dollar is coming off big. We already know that's reflected in the price of gold rallying. Okay, the gold adjusted value of the dollar is at a record low. In other words, how much you can buy with a dollar. But if you had a bond market crisis, wouldn't that be interesting? A safe haven, but the most indebted nation in the world, an insolvent nation. How is that bond market supposedly a safe haven where gold plays off against the dollar? And maybe in this new generational digital era, Bitcoin becomes the new T-bond in a flight to safety. I don't know. I'm just throwing it out there for debate, and I'm going to show you some reasons why it's not so crazy. Let's start with inflation. All right, inflation keeping the Fed on hold until the Fed acquiesces to higher inflation, protect the economy, because we have so much debt that without growth, we will collapse. Under the weight of that debt, the house of cards will come down. All right, but we look at inflation. Now look, first of all, 2% is the Fed's target, all right? And understanding this is, CPI, not PC, but so what? 0.2 was this month's reading. That's 2.4 annualized. In fact, out of the last 9 months, you've had 8 months above the Fed's target, all right? And when you go back to last year at this time coming up, May, June, July, the next 3 months, you were 0 and 0.1. Which lays out a base effect that will lift the year-over-year rate in May, June, July, all things being equal, assuming there's still some, inflation on a monthly basis. Let's talk about inflation because energy is lower. Energy prices were much higher a year ago, all right, all throughout to November. Unless we get a huge rally in gasoline prices, that will be a negative effect. So that will keep down the headline number versus the core number. All right, but the real inflation in the real economy, 72% of the real economy is services. And in services, there's 79 indexes of service, CPI, X energy, and energy is only 2 things. So in that case, understanding there's overlap, all right, understanding that. So what? This is a great read on where the inflation is. That is the biggest part of the economy. Of 79 indexes, 60 are above 2%, 76%, 3/4. Versus only 19 that are below the Fed's target. Out of the 69, out of the 79, 9 are below 0. You have 9 that are in deflation. But 12 are above 5% year over year, and 5 are above 6% year over year. The skew is decidedly and clearly upwards. 26 of 79, or 1/3, are running hotter than 4% year over year. 1/3 are running more than double the Fed's target. Do we see where we are with inflation? Because we got a 2.3 print, it's probably going to be the low of this cycle for the year perhaps, and not a reason to get too excited about bringing the Fed back into play quick. Although they'll come back into play, and when they do, it'll be even that more demonstrative because inflation won't be lower. Do we get where we're going with that? And that'll impact the dollar in a big negative way. New York Fed report, look at the uptick in credit cards. You can't tell me this isn't because people are desperate to pay the bills. We see that in the other Fed household survey of consumer expectations. Expectations for inflation as high as 6%. The dispersion on expectations for income as low as minus 1.7. So from that perspective, you see why less households feel good about the future and more households feel very bad about the future. Next 12 months, their own financial situation. All right, credit cards up big, and the delinquency rates skyrocketing to levels we haven't seen since the 2008-2009 financial crisis. I've been saying this for a while, but you're approaching 13% credit card delinquencies that are 90 days late. All right, look at auto loans, back to 5. I mean, almost back to the 2011, in the wake of the crisis highs that we saw there above 5%. Almost a record high in delinquency rate, seriously delinquent auto loans. It's like a crisis that no one's talking about. Now, yeah, foreclosures are low, nominally, historically, however you want to say it. This is a low number. Having said that, you had forbearance forever. What kind of pent-up demand might be in here? Thank God for the rise in home prices that has priced a lot of buyers out. That's helped freeze the transactional market, but that has given some home equity to people It's the one place where there's a tap that could be tapped into. Home equity, loans, the HELOCs, the whole 9 yards. Right? There's a lot there potentially, and that's probably part of the reason that this isn't higher. But the point is it's rising. The point is it's breaking out. The point is it's curled, bottomed, and is going up in every age group. Every age group. And that's the same with credit cards too. It's really amazing the breakdown of credit card debt and delinquencies in age group. Now this is a very important chart. There's a lot of writing. Let's just look real quick on one thing. I forgot to kind of minimize the writing on this chart. So far, first of all, the public borrowing requirements, the PBSR is what they call it, 1.9 trillion. We need to borrow from the public, 1.9 trillion. It's amazing. Take in the tax money, spend it all, and what do you do to fill the deficit? You go back and borrow from the public, which increases, I mean, you know, it's just kind of crazy. But nonetheless, 1.9 trillion. Through the first 7 months, they've only done 549 billion of that. That is only 28.9% of the money that's been borrowed. 5 months left to the end of September. You have 1.35 trillion or 71% of the total to be borrowed. Let alone that this year is 12% above last year in terms of borrowing from the public at almost $2 trillion. 1.4 trillion in the next 5 months. That absolutely, positively will weigh on the bond market. So how does the Fed approach this? Because what we see is the muni bonds getting cracked. We see the mortgage bonds back towards their lows, higher mortgage rates. You know, how much longer can the economy stand this dynamic while the Fed's not acting? And in fact, because now we have a potential, you know, a resolution to a trade war, now you have gone from pricing in definitely 3, if not maybe 4 rate cuts by the end of this year to now the 100% of only 1 and some chance of a second. That's not going to be much help for the bond market, okay, where the 30-year bond is pressing 5%, where you have 1.4 trillion in new debt to sell, let alone the refinancing of trillions, a lot of which is actually kind of front-loaded on the timeline to the next 18 months. I mean, holy mackerel, let alone the Fed is still QT. I could see a reversal there. NQT, then you're going to have to bring in some QE potentially with this amount of debt coming to the market without seeing the 30-year bond yield take out 5% and it's there. But we've anticipated this all the way back to here. We took out the 10-year moving average. When you took out the downtrend line, it was 40 years from Paul Volcker defeating inflation. This is what's caused all the debt creation, was this 40-year downtrend in interest rates and inflation. And now we have the reversal. That is a secular reversal. It's not going to change anytime soon because of all the debt. Reagan, Volcker, they had no debt. They created this boom by creating debt. And now you suffer really, you got to create $1.86 comparing household debt and public debt to GDP. It takes $1.86 in new credit creation to create $1 of new GDP growth. That's a problem. That doesn't work. You're in the black hole. So in this case, it's higher highs and higher lows, as we've been saying for the past 3 years. And here you are at a real crux of the matter point. Breakout above 5% is huge. And think of the reverberations from that to all the other things I just mentioned, particularly in the mortgage market. So gold, you know, kind of covers the dollar in purchasing power. And if you want to cover something in the bond market, what do? You don't go to dollar. Gold's had a big move. It's pretty high relative to where it was. I mean, in this digital age and what's coming next with the, you know, when you see all these things start to crumble under this debt regime that we've created that has to kind of turn over into something new, it does leave the digital era, you know, right in front of us in a bigger way. I've always believed in the metaverse, VR, you know, virtual reality. You're not even going to leave your homes, and some of the things that I have seen even 10, 15 years ago in terms of the technology that already exists in terms of putting this in place. COVID certainly accelerated all that kind of stuff. But how about if the new T-bond, the thing of safety, which now comes from the most indebted country in the world, which comes from an insolvent country, here's another IOU. The dollar's another IOU. Here's an IOU. We take in the taxes. We don't have enough money. We borrow from the public. What do? We sell bonds back to them that are valued in a currency that we're going to depreciate because we have to. Hello? So that does make a case for Bitcoin to become what it has yet to become and what people really thought it would become, and it hasn't. A safety valve. And you're there now. And how many more people can buy Bitcoin versus even gold? And where are you going to store your gold? And this is something new. I like both. I think there's no reason to even debate one or the other. Both. Absolutely 100%. Having said that, for the gold bugs out there, I think you're missing the boat on something. Everyone's going to jump the boat. And hey, our goal here is to make money to help our clients, all right, weather the storm coming and to try and keep pace with the debasement in the purchasing power of paper currencies, and that's everywhere. And in this case, that makes the case for Bitcoin. You shun the 60-40 model, that's blown up. If you ask me, passive investing mantra, that's gone as of now, literally. And you're talking about all fixed income. I mean, as the T-bond's pressing 5%, is it coincidence that Bitcoin's pressing 100,000 again? There's a little bit of an overlay to suggest there's a correlation here. I mean, probably not, but maybe. And if it is, it speaks volumes to what I'm trying to say here, just to make a point, all right? And again, my long count gives us the next upside target, and we called this move pretty well. I said 114. We got to 110. 179.5. And, just continuing. A couple more things real quick. Bitcoin's already new highs against the S&P, continues to outperform. 2 years of outperformance, still at a very high 40% over the last 52 weeks. Bitcoin has had a great pattern against gold, where it has held where it needed to hold, is re-exerting itself to the upside, and is beginning to build on a little bit of an outperformance. Gold, to me, has a correction, maybe as low as 2,800. We'll see. But right now, Bitcoin's in position to, for at least a time, appreciate against gold. Then we talk about Ethereum, because Bitcoin just made new all-time highs against Ethereum. Ethereum, new all-time lows, and now you've bounced back. You've taken out the down channel. You've gotten back to the 100-day moving average. You've eradicated almost all of this, what was nearly a 50% underperformance by Ethereum. And Ethereum against gold is at levels that in the past have proven that maybe Ethereum's cheap. Maybe there's some value to Ethereum. The overextended nature, too, of the long-term momentum is very telling. And Ethereum on its own, 3024 is a breakout. And you had this huge down move, and you were all the way back to the moving averages, the 52-week and 2-year, which never turned bearishly. Hello, McFly. Triple bearish trending moving averages. All three have flipped up. Inverted head and shoulders. Neckline is gone. You get above this level, 2911, opens the door for 3024, opens the door for 4,000. Opens the door if Bitcoin's going 180,000 to much more, even in Ethereum. One last thing we'll note here, too, by the way. Next week, Monday, very excited about this. Ripple futures start trading. All right, 50,000 Ripple. Right now, it's a $129,000 contract, $5 minimum tick. Beautiful. I mean, just beautiful. Why? Because Ripple's breaking out. I love this chart. It just looks really solid to me, and I want to like Ripple. It's one of my favorites out of the whole bunch in terms of where this could go in the future. So keeping an eye on Ripple, liking Ripple here, and you'll be able to trade the futures markets next week. If you want my stuff daily, we don't cover crypto every day. We cover all the global markets, specific recommendations, including in crypto, with stop losses, the whole 9 yards. Shoot me an email. You can get a copy of this full report, which is actually like 50 pages that I just finished, with all the inflation numbers, all the budget numbers, all the New York Fed numbers, and a breakdown more in depth of the bond market in particular. Shoot me an email at gregweldon at weldononline.com. Follow me on Twitter at weldonlive, and check out my podcast, okay? Money, Markets, and New Age Investing. Thanks a lot. Keep in mind, you can shoot me an email anytime. And at the Global Macro Strategy, we call it, and it has been, and my clients call it, the research that pays for itself.